Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing MPLX's stock so we can determine if it's a buy or a sell. MPLX transports and stores energy. Its assets include a network of crude oil, natural gas, and refined product pipelines. They have an inland marine business, heavy oil and marine terminals, also natural gas, NGL processing, and fractionation facilities. Fractionation is a separation process in order to create products, such as propane, butane, and ethane. Marathon Petroleum, ticker MPC, owns the general partner and majority limited interest in MPLX. Marathon is a downstream company with a market cap of $48 billion. MPLX is an MLP, a master limited partnership, pays a lot less taxes than a traditional corporation. It avoids double taxation. The company is headquartered in Findlay, Ohio, and was founded in 2012. Let's get started with the model. This is a large cap company, $34 billion market cap. They're trading at $34 a share, and they have 1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow does go up each year from 4.1 billion to 4.5 to 4.9 to 5 billion in 2022. Net income is a profit or loss on the income statement. It's revenue minus expenses. That was 1.5 billion in 2019. Negative in 2020 due to lots of write-downs, lots of asset impairments. It jumped way up to 3 billion in 2021 and almost 4 billion in 2022. Revenue is a sales for the company, and that dropped from 2019 to 2020, then jumped up to 9.6 billion in 2021, then 10.5 billion in 2022. They recently released their first quarter earnings, and this is their income statement. So for the first quarter of 2023, revenue of 2.7 billion. Last year was 2.6 billion. They do provide a breakdown of their revenue, but I think there's another chart that's more clear. Let me show you that. 1 billion of their revenue is in logistics and storage, 1.1 billion in gathering and processing. Service revenue is the delivery of the product through its pipeline. And they had non-ASC 606 revenue of 586 million. This is their 10Q, and the footnote reads, non-ASC 606 revenue includes rental income, sales type lease revenue, income from equity method investments, and other income. ASC 606 revenue is when you deliver the product or service to the customer. So I guess non-ASC 606 revenue is where they're recognizing the revenue before they deliver it to the customer. Their cost of revenue is 300 million. The cost to buy the products, to buy the oil, is 400 million. Purchases related parties is 361 million. This is purchasing and delivering product, but they separate it out on their income statement. When they refer to related parties on their income statement, they're referring to Marathon Petroleum. Since they own 65% of this company, they separate their revenue and expenses from their other business. Then you have depreciation of 300 million, G&A of 89 million, and other taxes of 30 million. So total expenses are 1.5 billion, down a little bit from last year. Their income from operations is 1.2 billion, up 136 million from last year. They spent 224 million of interest on their debt, 200 million last year. So their net income is 952 million compared to last year of 833 million. EPS of 91 cents compared to 78 cents. They have less shares outstanding. They have about 1 billion. Last year they had 14 million more shares outstanding. This is their operating section on their statement of cash flows. And the way you calculate operating cash flow, you start with your net income. Then you add or subtract the non-cash items on the income statement. We add back amortization, 17 million. We add back depreciation and amortization, 300 million. They reported a gain of 134 million on equity investments on their income statement, but that's a non-cash item, so we minus it out here. From those equity investments, they received $140 million of dividend payments. That is a cash item, so we add it here. I'll show you their equity investments so you know what they are. They break it down by logistics and storage and gathering and processing. They own 67% of Endeavor Logistics, but that's a VIE, variable interest entity. This means they have controlling interest of the company. They own more than 50%, but they don't have voting rights. Their total value in L&S is $1.9 billion. Their total value in GNP is $2.3 billion. So they have $4.1 billion in equity investments. These are all the companies they're invested in and the ownership of those companies. Then we have to adjust for changes in working capital. They received $38 million from accounts receivables. So they extended credit in the past and those customers paid in this accounting period. They spent $2 million in inventory. It looks like they bought product on credit in the past and they're paying it back this accounting period. They paid back $130 million in accounts payable. A $44 million cash inflow from Marathon. Even though they reported an accounting profit of $950 million, they actually generated $1.2 billion of cash flow. Let's look at the capital structure. $13 billion of equity, $20 billion of debt. They're 40% equity, 60% debt. Their net debt is also $20 billion, so they only have about $230 million of cash on their balance sheet. I gave them a WACC of 11%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $58 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $54 billion. We divide that by 1 billion shares, and we get a calculated stock price of $54. They're trading at $34, so they're trading at a 37% discount. It's a strong buy according to the model. Simply Wall Street values them at $40. They say the stock is 15% undervalued. 8 analysts priced this stock and the average price target is $40. The lowest $36, the highest $44. Another 14 analysts priced this stock and the average price target is $40. They say the stock is 15% undervalued. This is where the stock has been trading since it IPO'd. So it looks like it started out at about $28, and that was at the end of 2012. About 2 years later, it hit $85, its highest point ever. And then over the next 3 quarters, the stock really crashed. Oil came down a lot in 2015 and 16. So pretty much all oil stocks crashed around this time. And the stock fell below its IPO price. It looks like it bottomed out at $19. Then over the next couple of months, the stock did run up. It then traded sideways for about 3 years. It was coming down in 2019 into the beginning of 2020. Then COVID hit. It got to its lowest point ever, about $12. But then over the next year and a half, it hit $30. And it's been trading in the low 30s for a couple of years now. This stock is up 25% since it IPO'd. And the price of Brent crude is down 31% in that same time frame. So this stock has done a lot better than oil. Plus you get a dividend payment. They pay a really nice dividend and they raise it every year. It was 63 cents in 2018. It's up to 78 cents currently. It looks like they paid a special dividend in 2021. Their yield is over 9%, which they could afford at 62% of their free cash flow, 78% of their net income. There are 52 companies in the same industry as MPLX, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend that much in CapEx, but they do spend more than the average and median. Their debt to equity ratio is equal to the median. For every dollar of equity, they have $1.50 of debt. They pay a really high dividend, a lot higher than the median average. They generate lots of free cash flow. They rank 8th in market cap. Their price to book and price to sales are worse than median, but their PE and price to free cash flow are great. They generate lots of revenue and they're still growing. Their 5-year annual revenue growth rate is 22%. The average is 16%. So to summarize, I have them trading at a 37% discount. They've been around 11 years and they're not a one-trick pony. They do a lot of different things. In addition to that, their biggest investor is a huge downstream company, Marathon Petroleum. So that gives you a little safety net when investing in the stock. I rank their free cash flows, revenue, and ratios 8 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.